Hello, and welcome to our next podcast on stocks. The purpose here is to provide you with a general introduction to some key terms and definitions, as well as to some finer details about stocks, so we can continue our study of savings and investment. First, let us provide you with a few definitions. A stock is defined as a share of ownership in a corporation, and one who holds a stock is referred to as a shareholder. A shareholder can then both buy and sell their shares at a given price. Therefore, when an individual purchases a share, they are trading their money in hand for the equivalent amount of money on paper. And when this same individual decides to sell their share, or shares of stock, they are liquidating or turning their money on paper back into money in hand. So what is a corporation? A corporation is a type of business that sells shares of ownership to investors in the form of stock. This is a legal definition, and therefore, the corporations, some of which you see represented in the image below, must follow specific government rules and regulations. So where do I buy stocks? The most likely place would be the New York Stock Exchange, also known as the Dow Jones, or Wall Street in New York City. The Dow Jones includes the 30 largest stocks in the country, including corporations such as Walmart, Home Depot, and Disney. But there are also hundreds and thousands of other stocks that investors may choose to invest in, including those found on the stock exchange known as the NASDAQ, which includes technology-specific corporations and various other new stocks. The NASDAQ is home to over 3,000 stocks, including Comcast and Tesla. And finally, there are numerous other exchanges around the world. These are known as foreign markets, and some of them include the FTSE in London, the Nikkei in Japan, and the DAX in Germany. Does every company or corporation offer stock? The short answer is no. Some are private and include names such as Bloomberg, which is a financial software, data, and media company, and Albertsons, an American grocery company. What then are some main reasons a company does go public or begin selling shares? Well, when a company goes public, this is called their IPO, or Initial Public Offering. By going public, a company can sell shares to investors in an effort to raise money. It's kind of like a fundraiser for that company. Going public, then, allows the company to continue to grow and innovate their goods and services, and hopefully continue profiting. How do I buy stocks? Well, the first requirement is your age. You need to be at least 18 years old. Then you can contact a broker, or someone whose job it is to sell shares of stock. As you can see, there are quite a few of these brokers out there and on the floor of the stock exchange. You can also purchase stocks through online stockbrokers too, like E-Trade, Ameritrade, or Fidelity. And when can I buy stocks? The New York Stock Exchange opens at 9:30 a.m. and closes at 4 p.m. Eastern Standard Time, that is. Online trades can be taken pretty much anytime. Let's now transition back to some other key terms you'll need to know about stocks. When researching a specific stock, like anything else, there exist some very important details. For this part, we'll be looking at Coca-Cola in specific. First, you'll see the company name, the Coca-Cola Company, in the top left of our screenshot here. Immediately to the right, you'll see what's known as the ticker symbol, or the company's abbreviation and set of letters used by the stock exchange to identify the company, in this case, KO. Each company has its own specific ticker symbol. Next, you'll notice the company's share price, or dollar value for one share of stock. In this particular case, Coca-Cola was trading at $38.76 a share. Additionally, the company's range, or its low and high for the day, as well as the last 52 weeks, is commonly displayed. This data provides investors with a reference to both the company's short-term and long-term performance. So how does someone actually make money from stocks? The first answer would be through dividends. Some publicly traded companies pay their shareholders a percent of the company's profits, otherwise known as dividends. Logically, the more shares of a company's stock one owns, the more money one can make. The second answer to this question would be when one sells their stock. Again, this is the difference between money in hand or money on paper, which we discussed earlier in the podcast. Are stocks then a good idea as a financial instrument when saving and investing? The answer is historically yes, but it's also not that easy. For some, they need to refer back to answering the 3 rules of saving and investing. What can you afford to lose? What's your comfort level? And what's appropriate for your age? Finally, let's explain what many call their stock portfolio. This would be the collection of stocks you own. It could consist of 1 or several thousand stocks. Your portfolio makeup will depend on, first, your goals, including your retirement, whether or not you want to use these stocks in your portfolio to make extra money, or helping to pay for your kids' or grandchildren's college tuition. And secondly, your age. For example, are you close to retirement? And how old are those kids? Well, that takes care of our podcast on stocks, some key terms and definitions related to stocks, as well as some finer details surrounding them. If you have any questions, be sure to write those down and bring them back to class. We'll try to get those answered for you. Thank you so much for listening. Have a good day.